Today's episode is brought to you by SoundCartel. For the most part, the share market has been moving along quite nicely, thank goodness. And now, investors are operating in the lowest interest rate environment they'll ever remember. So how's that playing out for everyone? From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Whether you've benefited from tech stocks that have rocketed to dizzying heights in recent times, or you've dipped your toe into the share market elsewhere, what should you do to protect the gains you might have made? And what are the chances of a sharp correction? These are questions for investment advisor and commentator Greg Keady of APW Partners, who also shares his thoughts about ethical investing, another area which has taken off big time. If this attracts you, should you jump in, and what are the watch-outs? First, Heather Dawson asks, what has the very low interest rate environment meant for investors?
We haven't really seen, too many examples of interest rates being at this level before, historically. And I guess there certainly is a strong relationship between interest rates and inflation. Inflation at the moment, as at the December quarter, was about 0.9% for the year, which is certainly quite low. You'd have to go back to 1958, 1960 to actually see inflation at that level, slightly higher, about 1% or thereabouts for the 12 months. So it is quite unusual. Generally speaking, I guess, if you look at interest rates right now, the overnight rate, as we know, the target rate for the central bank at least, is 0.1%. And inflation at 0.9 means that interest rates theoretically and practically are lower than inflation. So in real terms, you're going backwards as a result of holding monies at short term. If you take a longer term view and lend your money for 5 or 10 years, at best, you might be getting at the moment for 5 years, maybe 0.5% to 1% in that sort of range. So it's bringing it up close to inflation, but still it's really on par with inflation. So there's not a real positive return from interest rates. If you go that much longer, over 10, 20, 30 years, that's when you start to see interest rates moving a little bit further above 1% into that sort of 2% realm. And maybe in time that might actually sneak up to 3%. Inflation is relatively low. We had a negative quarter through 2020. We had a slightly higher increase in inflation at the end of December, more so than what was expected. And lingering, at the surface across the board economically is this fear of inflation actually spiking. And what does that actually do for interest rates? How does it affect, obviously, household consumption, costs of living and so forth? So there's been quite significant amount of speculation around inflation actually exceeding the Reserve Bank threshold or target range of 2 to 3%, which ultimately could filter through to interest rates rising more rapidly than expected. But at the moment, interest rates are not expected to change really significantly at all, meaningfully the next 3 years. And realistically, looking at longer-term bond yield curves, like indicative future expected interest rates, we'd probably not like to see a significant change over the next 5 to 10 years.
So what's your advice to investors, Greg? Just get out of your term deposits and start looking elsewhere?
Well, taking risk comes at a price. You hope to be rewarded, but the reality is essentially that there can be long periods of no reward. So I think for a lot of investors have had to actually consider markets that they've never invested in before. So I guess the answer always to that question is diversify broadly. It's no different putting all your money in term deposits, putting all your money in the share market. There are risks associated with both of those extremes. Basically, investments are, what you're really doing when you're buying an investment is the right to a future cash flow, an earnings stream. So owning shares and owning the right, if you like, to participate in the growth of company earnings or company profitability comes with a lot of bumps in the road. So it's not prudent to just go from one extreme to the other. But diversifying, obviously, is pretty important.
Well, from low interest rates, what about the dizzy heights of some of the tech stocks on the market now, Greg, especially over in the US?
If you look at the top 10 companies in the US, for example, leading that charge essentially are Apple, Google, Microsoft, Amazon, Tesla's now in that group of companies as well. The top 10 companies in the US have a price-earnings multiple of over 33 times against an historical average of less than 20. And if you exclude them from the top 500 companies in the US, the rest of the market is trading at less than 20 times. So there's quite a disparity between the very large companies, very heavily, exposed to technology, and the rest of the market. The last time that we saw multiples like this essentially was through that tech boom. And what we know looking back through time is that multiples at that level historically have not maintained those levels necessarily. So investors just need to be very careful of actually what they're buying and what they own. Really need to understand the metrics associated with the valuations of the companies that they own. Do they have expensive companies in their portfolio? Do they have cheaper companies in their portfolio? What's the mix between, I'm being quite simplistic, but what's the mix between high and low relative prices?
But is there a chance that there could be a big correction with these massive tech stocks?
There's always a chance.
Yeah.
I guess historically, basically what markets do is like a big pricing processing machine, right? So new information comes in essentially that shocks the system. Pandemic is a classic example. We see very substantial falls. And companies that are trading in blue sky at levels essentially that are not necessarily justifiable, they have a tendency and a propensity to fall further. So it certainly is prudent. I guess on average, investors have actually made more money from technology companies in the last couple of years than any other segment of the market. So taking profits, rebalancing, diversifying broadly, and I guess not being too greedy for the gains that might have been made. Tax is often a motivation to avoid selling and rebalancing. If you have tax to pay, it generally means that you've actually done okay. So it's important to consider that and not be too frightened off by the tax bill.
Okay. Well, one more point, Greg, talking about things that are taken off big time, and that's ethical investing. That's really doing well now, isn't it? So should investors be jumping in there?
So ethical investing, I guess, is certainly globally, to say it's a phenomenon, it certainly has represented a huge shift in the mindset of everybody on the planet in terms of recognising the impact, I guess, of how businesses conduct their affairs. And so investor activism now is actually significantly impacting boards. Companies are more focused on the triple bottom line of the impact that they're having on the society and the community or the markets and the world that they live in. So it's not going away. This is actually here to stay. So investing with an ethical focus through a managed fund is, I guess, certainly an avenue for people to consider. But it's really important that people understand exactly what is it that they value most and how can they actually have an impact by excluding certain companies. If, for example, you wish to exclude the highest emitters of CO2 in the marketplace, what does that actually mean? What companies would actually be excluded? And you're comfortable with that. So it's not just the BHP and Rio Tintos, for example, and the resource stocks. It might be companies like ASX, which actually have significant numbers of warehouses that actually are excluded from portfolios essentially on the basis of CO2 emissions. It may well be that people have preferences for social exclusions. And it's fair to say that many people do not want to invest into companies that manufacture cluster munitions or nuclear weapon systems. And you have companies like Berkshire Hathaway, one of the largest in the top 10 companies in the US, in the world, a prolific investor into nuclear weapon systems and cluster munitions. So, it's really a matter of actually understanding very clearly, being able to articulate what is it that I actually don't feel comfortable investing into, that I'd prefer not to actually to provide capital into the market to support. And then ensuring that is, if you're using a managed investment particularly, which is what a lot of investors have been doing, whether through exchange-traded funds or active funds or more passive funds, is being very clear as to literally what companies are excluded, when they are re-included, because not all transgressors remain out of a portfolio. Rio Tinto obviously has been in the news significantly for its poor decisions essentially, but that doesn't necessarily mean it's excluded from an environmental, social governance framework. Many of these ethical investments essentially, you have to be very careful. At the risk of sounding cynical, there is a marketing imperative, if you like. There's more fees charged in this environment. If you were to look at the comparison of fees for managed funds that have an ethical overlay versus those that don't, there is a significant difference in fee. So, I think you need to be very careful to understand exactly what it is you're excluding, why it's being excluded, how it gets re-included at any point in time, and the impact of the cost that you're actually paying for that additional layer of selection and preference in the portfolio structure, because that can have a detrimental impact on your overall accumulation of wealth. An additional 1% over a decade or 20-year period will have a material impact detrimentally to your wealth. So it's very important to understand the impact of those strategies because it's not a level playing field.
That was Executive Director and Principal Advisor of APW Partners, Greg Keady. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media And head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.